We put an entire team together. Financial coach, that's me. Insurance agent, that's Daniel. CPA, financial advisor, mortgage professional, to all of us to come into alignment to solve for this person's needs specifically. So a lot of people, coming together. And I think you absolutely need a financial team as we get older and older, because you want to be able to simplify your life as we get older and older. We don't know what will happen to us cognitively, right? Our memory, right? Different things can happen that to the best of us, memories go, just cognitive function, mobility, things decay. And so the last thing you want to be doing is running numbers on an Excel, make errors, make a financial decision, and it blows up in your face, right? Rather than it's just like, how do we just secure income according to your lifestyle, and then anything above that is gravy, right? So that's what occurred there. And so with that, we have the home equity conversion mortgage strategy, which removed the entire obligation to pay this mortgage. So the mortgage gets removed entirely. And now we have this home equity conversion mortgage, which is in the reverse. So the debt is still, quote unquote, there, but it's not obligated for her to pay that debt. And yes, the debt is increasing now, but she is receiving an income from it. And with other strategies in place, when she eventually graduates Earth, she's not going to leave a massive debt behind for her family. And if we did leave a massive debt behind, we're going to have other vehicles in place to basically pay for that strategy set up for the heirs to take over that specific property. Then we did the annuity rollover, the existing annuity, rolled it over. Now that annuity is going to pay out more income, $2,200. We paid off the car, right? So that's $353, increased cash flow. Part-time work, $2,000, income going up. Additional annuity, right? And mind you, I didn't even count this 2K and that 48 and that 4810. That's alimony and the Social Security. So I didn't even count that. So technically her income is back where we first started, even though we removed that 1259. So that's cool. And then we got an additional annuity based off of cash savings that she already had, and that will pay an additional $900. So we're looking at $922 and $810 of guaranteed lifetime income so far, right?
Yep.
And the HECM over time will also be able to pull income from that. I'm not sure if you have the numbers on that in terms of what that will potentially produce for her in the next couple years. I know right now we're not pulling anything from it, right?
No, it can. It has that ability to actually produce income. The mortgage broker could bring that on, and it depends on the projection they run based on appreciation and stuff like that. So I don't know that's when we're doing all this income mapping, we're only using things that we can guarantee and count on. So the absent of debt we can count on, the annuities we can count on, the HECM it may provide income, but it also may not. It depends on how the house appreciates. So.
Right. The whole purpose of it was to remove the 1423 today so that we take that cash flow, save it, and use that to increase it, whether it's to buy more annuities later on.
Right.
And then if it doesn't produce anything, I mean, we still have the ability maybe to buy life insurance. So I'm not sure if that's another thing that we're looking at here for her. Maybe it's some sort of a life insurance strategy for her. To be able to have the death benefit to just basically wipe out anything she would leave behind. So far we've achieved guaranteed income of $3,910 3 years from now, June 2026, if I'm not mistaken, or a little bit after that, maybe 2028.
Yeah, she's still going to get some time with that alimony, and
right.
She's got some time on it. And the other thing, Denzel, if I can jump in, is not only did we get back to the original income number she was before, but that was with the absence of the annuity and the absence of the alimony. So what's important to touch on in this example is because she was working with you, okay, you're like the primary care physician, right? You're there helping her with everything. You notice this particular cash flow challenge she's going to have coming up in 3 years in retirement. You bring in us. And now, if you go back to your screen real quick, that whole sleeve of that whole team you wrote on that chart, right? Right in the middle, right? The team,
Yeah.
all of those professionals, first of all, those are just the ones that made the cut. We took her scenario to multiple people in each role on the team. I wasn't even the insurance agent in this case. We brought in a different agent. So, we this whole team that came about, first of all, didn't cost her anything
Yeah.
to get an evaluation from everybody in a complete environment with each professional present. And the other thing was, not only did it not cost her anything, we evaluated it within our team, multiple professionals. We picked the best ones that came here. And a lot of people have told me over my career, they're like, Daniel, why do you run your organization like this? You could be making way more money if you were like an affiliate with all these different people, right? There's a CPA, there's an advisor, there's a mortgage professional. But I never do that. I always just bring in the best people when we have a solution, a need like this, because then when I need everybody on the team to step up for me so we can solve this case, everybody's there and willing to participate.
Right.
Now, she had created some additional agreements, that she would pay for, obviously, right? Like, so engaging, the tax attorney or the CPA or the advisor, those are going to come with additional fees for their services.
Right.
But there was no cost for her up front to go through this process. It's not like I said, hey, pay us $5,000 and we'll build you a customized retirement cash flow. This was just because we put our best foot forward every time. We wanted to be an extension of your team. We're like a specialist, but look at all that value you get with just one referral, right? So you're the quarterback, you're managing the cash flow and helping direct everything. And because you brought this in, there's just a lot of value that can be created from that one referral, which is what I wanted to touch on.
Yeah. That's huge. That's exactly what I want to be solving for with my clients. This right here is, just so the audience knows, like, more case studies I want to be showing like this, because now that I've been on YouTube for 6 years, I have clients that I met them when they were 52, now they're 56, 57. Clients that are 55, now they're 60. I have clients 60, now they're 65. So they're in retirement now. They have fully retired, but there's still more things to solve for, right? That they have questions on. And that's where my knowledge became limited, because velocity banking, for the most part, is solving for eliminating debt, increasing cash flow, reducing expenses, and having capital to either accelerate debt or create income with. But what it doesn't necessarily solve for is lifetime income, guaranteed lifetime income, certainties, removal of key risk. Velocity banking can become a risk, right? Later on.
Oh yeah.
So knowing that, okay, wait a minute, when does it make sense for me to turn this thing off, right? And one of those ways to turn off velocity banking, for those of you listening who may have a first position home equity line of credit or all-in-one loan, right? And you pay off your home, now it's there. Now for the duration of that draw period, maybe you leverage it now to create income, and that's great. And let's say you pay off the line again, and now the line of credit is no longer in the draw period. Well, one way that we could use that is by turning off the revolving feature altogether, turn on that home equity conversion mortgage. And that's something that we can dip into later on if it makes sense, right? So that's like one thing to keep in mind. And then on the other part about when it comes to, say, infinite banking, right? People who are trying to, max fund money into their cash value life insurance policy. They're trying to save more money into that because they think that that is a good income vehicle for them. It's a tax-free income vehicle, which yes, there's truth to that. But what happens when you start at 65? What happens when you're starting at 70? Does it still make sense to buy an expensive whole life insurance contract for the potential of a certain dollar amount tax-free? Or could an annuity do the same thing for less cost, and then maybe we only purchase life insurance according to what we need and what we want to
Mm,
leave behind and
I
just
like
pay a
it.
certain dollar amount for that. Meanwhile, your annuity is doing what you thought your cash value life insurance policy would do, and it's doing it better, right?
Yeah.
Paying more and on a guaranteed basis, even if the money runs out. So a
Yep.
lot of cool things there that we can, really,
Yeah.
really get into. So with this, where are we at today with this particular person here on the board? What should be their primary focus as it relates to the cash flow they're producing right now? Because now they're in a really healthy cash flow position, especially with that 4K alimony check coming in consistently, right?
Yeah.
Is there any additional things that they should be mindful of? I've already educated them, hey, let's avoid debt as much as humanly possible, right? Let's not, go on spending sprees. Let's create the lifestyle we actually want by
Mhm.
measuring it. So if you do desire to take vacations, if you do desire to buy clothes, buy shoes, let's actually put that in our month to month living expenses. This way it's not an unknown, unexpected expense. So we
Yeah.
can have a clear idea of what our true cash flow actually is when you factor in gifts, vacations, travels, right? So that's what
Yeah.
I've shared with her so far is be
Hmm.
mindful of debt, be mindful of our lifestyle. It will increase, right? And so what would be some additional things that you would like to maybe throw in here, or if you want to take it in a different direction, let me know.
Yeah, I mean, there's new risks, right? She's going back to work. So now she's got regular risks to deal with like we do, right? Like what if she got hurt on the job and couldn't make her wage, right? So we, are looking into some ways to help make sure she's got some protections for those things put in place, right? So she's
Like
got
what?
other risks.
Like what? Like health insurance? Like
Yeah, like
disability?
health. She's got the right insurances, right?
Okay.
Health insurance, disability, the right car insurance, the right umbrella policy. All these things matter, right? And so that's why it's so important to work with a team like this because, if you think about that example, like give this scenario to the average person and then have them go run all over town and meet with all those different professionals. The,
Right.
just to get that team on the board, that was like 12 or 13 meetings we had just to get those people on the board, to get to her to have a meeting.
Mm.
So, I mean, that's a lot of time, that's for one person. And not to mention, it turns into a bad game of telephone. So, what happens to the average person is they go to the CPA goes, okay, you need to do this. Then they go to the insurance agent goes, CPA's nuts, you got to do this. Then they go to the advisor and they go, both of them are nuts, you need to do this. And now they're just sitting there with like a bunch of people pulling them in different directions and feeling just absolutely like they're going nowhere. And they
Yes.
don't have the financial experience to be able to understand each discipline, meet them at their level of understanding, and then try to translate that over multiple disciplines. It's very hard to do. It's not as easy as you would think. Not everybody's always on the same page. In fact, a lot of times people disagree, and you have to again take it from their scope of knowledge, trying to apply it to another area, and that's hard to do. So that's really again part of that value. But what she's got to focus on is this 5 year period because she now if she couldn't work, could she supplement the income she's making part time from her portfolio? Yes. Okay, that's already covered. So she's okay. But again, it really works better if she can go back to work. And plus, she said that was part of what she wanted to be doing during that time. So, we're going to be looking at those kinds of things to make sure that we're helping meet her with what she needs during this new period of working. But she's able to bank quite a bit of money for the next 3 years. So that's really helpful. So, as long as she can do that, this works really well. And I feel really proud that we were able to put her in a position where she's telling us, I mean, earlier this year, she's looking at this, impending crisis going, I'm so stressed out. Now
Right.
she's like, oh my God, thank God for Denzel and putting all this together because now I feel stress free. I feel excited. I can travel again. I can enjoy. She's not going to get sick or develop some type of illness or stroke, God forbid, from the stress of knowing that she's heading towards a financial cliff. Now she's not. So that's what it's about at the end of the day. Like people always want to argue with me about like, well, isn't this the best strategy? It's like the best strategy is the one that helps the client say what she told us. I think that's the best.
Yeah.
If she can get to a place where she's like, I'm happy again and life is about life again, not about money,
Mm-hmm.
then then I feel like we're all doing our jobs.